You've seen the titles, How I Turned $100 into a Fortune, and you probably thought, yeah, right, another get-rich-quick fantasy. But what if I told you that title is real for me? Not because of some risky crypto bet or a 1 in a million stock pick, but because of a process that's so simple, it's almost boring. In this video, I'm not selling you a dream. I'm going to show you how a small, consistent investment can quietly snowball into a life-changing amount of money. It all comes down to one powerful force most people ignore. I'll show you the exact mindset, the simple tool I used, and the one habit that made it all possible. Patience, the promise, and the disclaimer. So before we get into it, let's be totally clear. This is the Get Wealthy Slowly plan. The fortune wasn't built in a day or a year. It was built with patience, discipline, and a total shift in how I thought about money, moving away from just earning a paycheck and toward owning things that build value. A high salary doesn't make you wealthy. Owning assets does. And I have to say this up front. I am not a financial advisor. This is just my story, shared for educational and informational purposes. It's what worked for me. You should always do your own homework and maybe chat with a pro to figure out what's best for your own life. My journey is my own, but the principles are universal. My goal is to show you what's possible when you have a plan and the grit to stick with it. The light bulb moment, the magic of compounding. The entire foundation of this strategy rests on one of the most powerful forces in finance, compound interest. It's a force so powerful, it's often mistakenly credited to Albert Einstein as the eighth wonder of the world. While he probably didn't say that, the power is undeniable. Put simply, compounding is earning returns not just on your initial investment, but on the returns you've already made. It's interest on your interest, and it's what makes your money grow faster and faster over time. Think of it like a snowball. You start with a small handful of snow. That's your first $100. As you roll it, it picks up more snow, but the bigger it gets, the more snow it picks up with every single turn. Your little snowball eventually becomes a massive boulder. That's compounding. Your money goes to work for you, and then the money it earns starts working for you too. Let's use a real-world example. Imagine you invest $100 a month and earn a historical average market return of around 10% a year. In the first year, the growth feels tiny, almost pointless. But after 30 years of consistent monthly deposits, that small habit could snowball into over $200,000. That was the light bulb moment for me. I realized my job wasn't just to save money, but to put my money into a system designed for this kind of exponential growth. My story, the first step. My journey started just like it might for you, with a little bit of cash and a whole lot of doubt. I had about $100 left over after paying my bills, and I felt that classic pain. I don't have enough money to even start investing. It felt like trying to fill an ocean with a teaspoon. What difference could $100 possibly make? But then I couldn't stop thinking about that compounding snowball, so I decided to run an experiment. What if I treated that $100 not like pocket change, but like the seed of a future fortune? What if I promised myself I'd plant that seed every single month, no matter how small or insignificant it felt? That was the most important decision I made. The dollar amount didn't matter. The consistency, the habit, was everything. I had to prove to myself that the process actually worked. That first $100 investment was the hardest because it felt the most useless, but it was also the most important because it was the beginning of a lifelong discipline. The how-to, the simple boring plan. So how did I actually do it? The plan is so simple that most people look right past it, searching for some complicated secret. First things first, before you invest, it's a good idea to have a basic emergency fund saved up and to have paid off any high-interest debt, like credit cards. Trying to out-earn a 20% credit card interest rate is a game you're not likely to win. With that out of the way, here's the three-step process I followed. Step 1, the account. I opened a brokerage account. Think of it as a bank account, but for your investments. Specifically, I chose a tax-advantaged retirement account, a Roth IRA, which lets your investments grow completely tax-free. You can open one online with firms like Fidelity, Schwab, or Vanguard in about 15 minutes. Step 2. The investment. This is the part where everyone gets overwhelmed. I didn't try to pick the next Tesla or Amazon. I didn't day trade. I bought one thing, a low-cost S&P 500 index fund. An index fund is just a big basket that holds tiny pieces of lots of different stocks. An S&P 500 fund holds a small piece of 500 of the biggest, most successful companies in the US. Instead of betting your $100 on one company, you're spreading it across the whole market. It's the approach famously recommended by legendary investor Warren Buffett for most people. The best part? Because these funds just track the market instead of being actively managed, the fees are incredibly low. That means more of your money keeps working for you. Step 3. The habit. Automation. This is the secret weapon. I didn't rely on my own memory or willpower. I went into my brokerage account and set up an automatic transfer of $100 from my checking account every single month. Then I set it up to automatically invest that $100 into my S&P 500 index fund. This set it and forget it approach is a game changer. It makes sure you're consistent and it takes all the emotion out of it. You're no longer asking if you should invest this month. The decision is already made. If you're finding this breakdown useful, do me a favor and hit that subscribe button. It's free and it's a huge help to the channel. The journey navigating the storms now. For a reality check. This journey isn't a straight line up. Investing in the stock market means dealing with volatility. There will be bad years. I'll never forget the first time I saw my portfolio drop 20%. Every news channel was screaming about a market crash. My gut reaction, and it's a very human one, was to sell everything to stop the bleeding. We feel the pain of a loss about twice as much as the pleasure of an equal gain, which is why so many people panic and sell at the worst possible time. But I had a plan, and that plan was built on decades of data, not daily drama. The S&P 500 has been through wars, recessions, and pandemics, and it has always recovered and hit new highs. Historically, the average annual return has been around 9 to 10%. I had to remind myself that downturns are a normal part of the process. In fact, I learned to see them as a sale. When the market is down, my automatic $100 investment was buying more shares than it did the month before. Sticking to the plan during the panic is what separates successful long-term investors from everyone else. My boring automated plan forced me to stay the course and buy low, even when my emotions were screaming at me to run for the hills. The shocking power of time. If there's one thing more important than how much money you invest, it's time. The earlier you start, the more insane the compounding effect becomes. Let me show you what I mean with a powerful example. Meet two friends, Sarah and Mike. Sarah starts investing $500 a month at age 25. Assuming a hypothetical 7% average annual return, by the time she's ready to retire at 67, she'll have nearly $1.5 million. Now her friend Mike invests the exact same amount, $500 a month, in the exact same investment. The only difference? He waits just 5 years to start, at age 30. When Mike retires at 67, his account has just over $1 million. Let that sink in. A 5-year delay, even though he invested consistently for 37 years, cost Mike almost $500,000. He only put in $30,000 less than Sarah overall. But his final nest egg is hundreds of thousands of dollars smaller. That is the jaw-dropping power of time in the market. It's not about timing the market. Every year you wait is a year your money isn't working for you, and that's a loss you can never get back. This is why starting now, even with just $100, is infinitely better than waiting until you think you have enough money. Your story begins now. So how did I turn $100 into a fortune? It wasn't one big, brilliant move. It was the result of 1,000 small, boring, disciplined decisions. It was the decision to start small, to pick a dead simple strategy, to put it on autopilot, and to find the mental strength to ignore the noise, and just let time and compounding do their thing. The fortune was never about the first $100. It was about the consistency that came after it. It It was built one automated investment at a time, month after month, year after year. It's a slow, steady path to wealth that's available to anyone with a little bit of discipline. The secret is that there is no secret, just a simple plan and the patience to see it through. My story started with just $100 and a question: what if? The only real question now is, what will your story start with? If you want to learn about the specific low-cost funds that are perfect for beginners, click the video on your screen right now called The Best Low-Cost Index Funds for Beginners. Thanks for watching.